back with another video today, and I'm just gonna expand on what I was talking about yesterday, where I made a video about Justin Trudeau and the economy and the state of the economy and how well the economy is doing right now in regards to the Bank of Canada cuts and this and that, right? So just to expand, I mean, a lot of you probably heard that the Bank of Canada was cutting their rates. So if you're wondering if they're going to continue to cut rates, let me give you the answer right now. And that answer would be yes. The inflation crisis that we're facing has been curbed, and now the bank will be moving into a state where they are going to be not seeing how much they need to cut, but how fast they need to cut the rates. So I just wanted to put this out there for people who've been like, I know we've been hearing about these rate cuts and hikes for the last 3-4 years now, but now we're at the time that is a crucial point where the amount of rate cuts that come and how when they come will really affect the economy, and in terms of if we're going to go into a recession or not. So this article here just today by the Financial Post says Bank of Canada rate cuts needed to keep recession at bay. Desjardins. So this seems like a guy from Desjardins, Royce Mendes, managing director and head of macro strategy at Desjardins Group, talks about Bank of Canada's latest monetary policy decision and what it tells us about the economy and where interest rates go from here. The bank lowered its policy rate to 4.5%, but Mendes says there's further to go. Okay, that's just an opinion piece, a little bit of somebody from Desjardins, but that article is short. I wanted to go into this article right here from the Globe. And the Globe says the bottom line, Bank of Canada should keep cutting interest rates. So Vice President Jeremy Cronick is the Associate Vice President and Director of the Center of Financial Monetary Policy at C.D. Howe Institute, where Steve Ambler, a professor of economics at the Université de Quebec et Montreal, is the David Dodge Chair in Monetary Policy. So the article says that inflation increased to 2.9% in May from 2.7% in April. However, then it ticked back down to 2.7% in June. However, there were indications that the labor market was weakening and there was a stagnation in the country's per capita GDP. So these are indicators that people were saying that the bank would cut rates before they did so last week, and they were correct. And the bank indeed did cut the rates because these are worrying indicators that show that there is a risk of recession, and the landing from these inflationary measures, austerity measures, could be quite hard landing, not a soft landing as they would say. Whether the bank has entered an easing cycle is no longer the question. The only question left is how far and how fast the Bank of Canada continues to cut interest rates, as I said before. There are several upside risks to inflation in the near future which could cause the bank to pause its rates cuts. We think it shouldn't. Here's why. And this is an editorial piece from the Globe, just to remind you guys. The first upside risk comes from the volatility in the shorter-term inflation numbers. This is owing to certain components of the consumer price index. For example, energy prices in general and especially gasoline prices fluctuate a lot, depending on the conditions in the rest of the world, both economic and geopolitical. So what it says here, from my understanding, shorter-term inflation numbers are affected by the volatility. right, of certain markets. So we in Canada run off the gas and oil markets, and energy markets as well, right? And those are a very big key component of our economy here. So, if they're volatile, then of course the financial situation of our economy will be affected, right? Because they're such a big part of our economy right now. So the article continues, the shorter term indicator, inflation over the last month or over the last 3 months, has the advantage of excluding what was happening to inflation more than 6 months ago, which the year-over-year measures the bank's targets cannot. Therefore, it can sometimes give a better indication of where inflation is headed in the near to medium term. Unfortunately, these numbers can vary quite a bit from month to month. Overall, CPI inflation throughout the last month was under 1%. All inflation numbers reported here are in annualized terms, which is encouraging but was above 3% in both March and May, after having fallen below zero in the first month of this year. So that's a bit worrying, of course. Consumer price index. That means, I'll just continue reading the article actually. They'll explain it here. Even core inflation, which excludes more volatile components of inflation, has moved a lot from month to month. CPI median and CPI trim inflation, the core numbers followed closely by the bank, were high, with both coming in at 2.9% in June and over 4% in May. This is where longer term trends matter. The 6-month rates can move us away from where things were more than 6 months ago, giving us a more accurate picture of where things stand today, and can also deal with the volatility of month-to-month or 3-month inflation measures. And here, CPI trim and consumer price index median are clearly on a downward trend at 2.2 and 2.1% respectively. The bank should ignore the short-term swings and focus on the trend. Just wanted to actually explain what consumer price index is, right? So the consumer price index is an indicator of inflation, more commonly known by its acronym CPI. So, definition, which the CPI measures the percentage change in the price of basket goods and services consumed by households. So, essentially, it's just the price change you see as a consumer from whatever period range they use. It could be month to month or year to year. Basically, it's the price change. If something's like $10 in January, then it will, if it had gone up 20% in its price or something, it would be $12 the next month, right? So that's CPI. So you would want the CPI to be going down because you don't want to pay more, right? So that's the CPI, and the article is basically stating to us here that the CPI is on a downward trend right now. Okay, so the article suggests that the bank should ignore short-term, volatility, and instead should focus on the respective trend. All right. Okay. Now, the second upside risk, comes from components of the CPI which have persistently shown high inflation. One of the most important of these is shelter. Shelter inflation was above 6% over the last 12 months and 3.7% over the last month. So, meaning that inflation in terms of shelter, let's see what that means, because even I don't know what that means. All right. Shelter inflation. Meant to measure the average cost of housing in our case, Canada, the Canadian economy. So yeah, it's just the housing cost then, and what I thought it would be. So that's gone up. No surprise there. Rent and mortgage interest costs have been the components driving this high inflation. Rent is driven by structural factors such as immigration and barriers to supply such as zoning restrictions, red tape, that are out of the bank's control. Mortgage interest costs, on the other hand, have been driven by the bank's own interest rate hikes over the last 2 years that will eventually fall, of course. And with the mortgage interest rates cost, inflation is 1.9% right at its target. And so basically, the article is suggesting it's the government's fault. Okay, the zoning restrictions is in the hand of the government. Immigration isn't in the hands of the government. So shelter inflation was 6% over the last 12 months and 3.7% over the last month. So it's clearly suggesting that. Then they say also here that the mortgage or interest rate costs are falling within target. So the bank's doing its job, the Bank of Canada, but the government's not helping out. Okay. Finally, there are substantial upside risks to inflation stemming from geopolitics. Notably, the U.S. election, renegotiation of Canada-United States-Mexico trade agreement, and a push for deglobalization. Tariffs by the U.S. and retaliatory tariffs imposed by Canada and other countries from which we import would increase inflation. So the world is becoming a more volatile place, of course, so there could be unexpected or unforeseen economic changes. That is understandable. Such an increase would be temporary as prices would shift to higher level, and then inflation would continue as before, but on a higher price path. The Bank of Canada can do nothing about this kind of inflation, short of a monetary policy restrictive enough to push prices down in order to compensate for the one-time impact of the tariffs. If it does not want to do this, and it shouldn't, the bank can use its communication tools with the public to explain why they are looking past this temporary effect. Excuse me. The bottom line, the Bank of Canada needs to carry on cutting the rates as inflation gradually subsides. Otherwise, in real terms, after adjusting for inflation, its monetary policy will become gradually more restrictive, even if it leaves the overnight rate where it is at. This would risk pushing the economy into recession. Basically, the bank will be doing its job. What the government can do to help, Mr. Trudeau, is to curb the inflation in terms of areas that it has control over, like shelter. It can slow down the immigration that is coming into the country and pressing down on the housing market here, causing the prices to go up. And they can also take down the red tape that is honestly completely useless. All these building codes and all these payments you have to make to just get stuff built, and through the processes, it's just so much garbage, honestly. Just build a house. It's not some sort of rocket science. We don't need 10 years to build a neighborhood in this country, okay? To get approved to build a neighborhood in this country. It's really simple, okay? Really simple. Just cut the red tape down, cut the bureaucracy down, and cut the useless waste and people who are taking up space, honestly, in their positions, who are just trying to justify their positions by holding these kind of red tape related jobs, okay? Cut it down. We have had enough now, and it's time to bring things back under control and back to rational, decision-based making. Thank you for listening to the video today, guys. Sorry for my lapses in speaking and the cut, but I hope you enjoyed, and I hope you learned something, found something interesting today in this video, and I'll see you guys later. Bye.